As the world's second-largest economy with a fundamentally different market system compared to the US, it is inevitable that the nation offers fascinating insights into economics. The controversy surrounding China primarily stems from its economic policies and their implications for workers and consumers in the Western world, particularly in relation to trade. China has become the global workshop, manufacturing everything from low-quality disposable toys to high-end electronics. This dominance in production can be perceived as a threat to the US, which also held a similar position in the past. Consequently, this perceived threat has resulted in hostilities such as the US-China trade war and trade tensions with other nations, as China expands its influence worldwide. The phrase, currency manipulation, carries a negative connotation. Being accused of manipulating anything is generally unfavorable. However, we must determine whether this is merely a matter of bad branding or a genuine covert attempt to undermine competition. To assess this, let's examine how a nation controls its currency and how it affects price competition and trade surplus. In general, most nations aim to export a significant amount of goods and services while importing only what they genuinely need. This balance between imports and exports results in either a trade surplus, when a nation exports more than it imports, or a trade deficit, when it imports more than it exports. Trade surpluses and deficits are commonly discussed in political discourse. Politicians often use the fear of a trade deficit to suggest that a nation is losing its self-sufficiency. Unfortunately, this concern can hold some truth. Free trade is generally beneficial for the overall wealth and prosperity of nations engaged in it, but it can also come at the expense of local industries. For example, the UK previously had a robust automobile industry, with General Motors operating as Vauxhall alongside other manufacturers like Mini, Rover, and Jaguar. These companies employed tens of thousands of workers, but their cars were generally of poor quality compared to their German, Japanese, and American competitors. The British government protected these local manufacturers by imposing import tariffs on foreign cars. These tariffs, which are taxes on imports, could be quite substantial. This meant that a Toyota Corolla, which could have competed with a Vauxhall Astra in a fair market, would become too expensive for most households due to the 30% import tariff. While this protected local businesses and their employees, it ultimately resulted in an overall loss. Today, the world benefits from the ability to purchase decent cars at reasonable prices from businesses engaged in international competition and trade. As nations realize this, barriers to trade, such as import tariffs, have become less common. Nevertheless, some countries still seek subtle advantages, with currency devaluation being a key strategy. At first glance, a low-valued currency may seem unfavorable. If a news report announces that the Japanese yen has lost 3% of its value overnight, one might worry about Japan's situation. However, having a low-valued currency actually offers significant benefits. For instance, it makes importing goods more expensive. When comparing the cost of a Cadillac and a Mercedes, they may be relatively similar in price. In the event that the value of the US dollar decreases by 50%, the cost of purchasing a Mercedes will double because it will require twice the amount of American dollars to pay the German auto manufacturer in euros. Consequently, American car buyers may choose to opt for a Cadillac instead, which in turn supports the American auto manufacturing industry. This achieves a similar outcome as implementing tariffs, but without violating trade agreements that typically prohibit such tariffs. On the other hand, if a German buyer faced the same decision, they would realize that they can now purchase 2 Cadillacs for the same amount of their euro-based savings. This makes the Cadillac a more attractive option compared to the local offering from Mercedes. However, it's important to acknowledge that not all Germans may prefer driving a Cadillac, so this example oversimplifies the situation. Nonetheless, a devalued currency can benefit local industries. There may be doubts about whether prices would adjust to account for the currency devaluation. For instance, trading 10,000 United States dollars for 1 million Japanese yen may not result in someone becoming a millionaire in terms of purchasing power. In reality, 1 million yen may have similar purchasing power to 10,000 United States dollars, or even less due to cost of living disparities between Japan and the United States. Over time, freely floating currencies tend to balance out in terms of purchasing power, although nominal figures may differ. The crucial distinction lies in the fact that China's approach is not simply reducing the price of its currency, but intentionally devaluing it. While price and value are closely related, an analogy can help clarify this difference. Imagine if Apple's shares were divided into 4. Someone holding 10 Apple shares on August 27th would wake up the next day with 40 shares. However, each share would only be worth a quarter of its previous value, so the investor wouldn't gain any profit from the split, assuming all other factors remain constant. The advantage lies in making Apple shares more accessible to small-time traders, who can now invest with a lower initial cost per share. Despite the difference in the number of shares, their value remains the same. China's currency manipulation is not equivalent to what Apple does with its shares to lower their trading price. Instead, it is more comparable to Apple attempting to reduce its share price by 50% without making any other changes. Apple would never pursue such a strategy since it aims to provide satisfactory returns to its shareholders. However, as discussed earlier, a sovereign nation like China may choose to devalue its currency for various reasons. Now, the question arises, how is this even possible? Economists often emphasize the influence of the market, stating that it is impossible to fight against market forces and succeed. So, how does China seemingly defy this unstoppable force and intentionally devalue its currency? The answer lies in their astute approach. China leverages market forces by effectively becoming the market itself. In the regular foreign exchange market, numerous entities engage in buying, selling, and trading currencies, ranging from individuals exchanging currency at an airport cash exchange for vacation expenses to large financial institutions like Goldman Sachs exchanging billions of USD for euros. However, the market for Chinese currency operates differently. The Chinese government establishes a fixed exchange rate, such as 5 RMB for every 1 United States dollar, and creates its own exchange where anyone can trade 5 RMB for 1 United States dollar or 1 United States dollar for 1 RMB. As long as this exchange continues to facilitate transactions, the price remains unchanged. To understand why, consider a scenario where someone planning a trip to Shanghai needs to exchange American dollars for RMB. If someone offers them 4 RMB for every 1 United States dollar, they would decline the offer because they can obtain 5 RMB for every dollar at the government exchange. Similarly, no one would be willing to give them 6 RMB for every 1 United States dollar because they could obtain a better rate at the government exchange, where they only need to pay 5 RMB for every USD. As long as this exchange operates and determines both the buying and selling prices of RMB, the exchange rate remains stable. One drawback of this system is that the government needs to maintain the exchange and hold a significant amount of foreign currency. For example, if someone wants to trade 2 billion RMB for 400 million United States dollars, the government must have 400 million American dollars on hand. Maintaining such a large amount of cash can be costly. However, it's worth noting that the Chinese government no longer needs to handle the majority of these transactions. People have come to accept the fixed exchange rate of 5 RMB per 1 United States dollar, leading them to trade among themselves at that price for convenience. However, they are aware that they can always resort to the government exchange if the price deviates. Interestingly, the cost of managing this exchange is similar to the expenses incurred through tariffs. Achieving the same trade advantage through managing an exchange incurs a cost equivalent to the deadweight loss experienced with trade tariffs. The difference lies in the fact that the government directly pays for the exchange with tax dollars, whereas taxpayers indirectly bear the cost of deadweight loss through higher prices. The key takeaway is that interfering with free trade comes with costs. While it may temporarily support local industries, the benefits may not outweigh the costs in the long run. If you choose to tamper with the market, be prepared for negative consequences on the bottom line. Now, for the entrepreneurial-minded individuals, you might be familiar with the concept of market inefficiencies, which implies that there is a profit to be made by exploiting those inefficiencies. In this case, the USD is technically overvalued in China, so you can take advantage of this by using your USD to purchase goods there, such as cars, furniture, or phones. The important part is that you will be able to acquire more goods with your USD than you would have been able to in the US. Once you have obtained your goods, you can bring them back to the US and sell them at a price unaffected by undervalued foreign exchange. Oh, wait a second, this is essentially importing goods from China to sell. Congratulations, you have made a profit, but you have played the game that China wanted you to play all along. In conclusion, currency manipulation, international trade, market intervention, Chinese business practices, and foreign exchange are complex topics. When these factors are combined, currency manipulation becomes a controversial issue. Is it something to be angry about? Well, yes, to some extent, but no more than you would be about a trade tariff, which I assume most of you are not very angry about. Moreover, China is gradually relinquishing control over its currency, and the RMB is increasingly influenced by market forces, with occasional interventions. Realistically, in the near future, it is likely to become a fully free-floating currency, positioning the RMB as a more widely accepted currency that could rival the USD. But we'll delve into that topic in our next video of the series. So, what do you think? Feel free to discuss in the comments section below. Thanks for watching, and if you enjoyed this episode, subscribe to Trending Updates.